A bank balance that never moves seems safe, but it often acts like a block of ice melting into a puddle. Survival requires a concrete wealth defense blueprint. This strategy is built on a specific historical pattern that has beaten inflation 94% of the time since the early 1800s. In 1980, a janitor in New York City began placing $50 a month into an S&P 500 index fund. By 2020, that small, consistent ownership of American businesses grew into $1.2 million. While this is educational analysis and not personalized financial advice, his results demonstrate the power of choosing the right asset class. The greatest hazard to long-term wealth is the invisible, safe-looking destruction of what that money can actually buy. Maintaining wealth begins by evaluating every asset for its real risk over 40 years. Cash and government bonds frequently fail this test, shifting from perceived safety to high-risk liabilities. During the 1920s Weimar Republic, prudent civil servants who followed the rules of saving cash were financially erased as the currency collapsed into denominations of 1 trillion marks. In the 1970s United States, retirees living on fixed bonds saw their standard of living drop by 50% as the price of basic necessities surged beyond their reach. Consider a Denver teacher with $340,000 in savings. Over 20 years, her balance stays flat, but actual purchasing power drops to $280,000. This persistent loss acts like termites, constantly grinding down the value of her money. Relying entirely on cash is a guaranteed mathematical bet that you will lose your purchasing power. Preserving value requires a transition from holding currency to owning stakes in businesses and real assets. When inflation pushes prices higher, productive companies like Coca-Cola or Siemens simply charge more. Their revenue and stock prices adapt to the rising costs. We see this behavior in real estate as well. The 2008 housing collapse created a vacuum in neighborhoods across the country. Institutional investors like Blackstone moved in quickly, absorbing 80,000 individual houses into a single, concentrated corporate portfolio. Large pools of capital follow a consistent rule. When water flows through one pipe, they buy the pipe. They prioritize owning the machinery of production. Moving from the role of a consumer to that of an owner is the primary mechanism for surviving these shifts. Stability comes from spreading ownership across hundreds of companies via an index fund, which removes the risk of a single business or property failing. Local concentration is dangerous. In 1991, the land beneath the Tokyo Imperial Palace was valued higher than the entire state of California, right before a massive property crash led to a lost decade. We see the benefits of broad ownership in Brazil. Between 2002 and 2022, the country faced persistent inflation. While cash lost 6.4% of its value annually, the Bovespa stock index delivered nominal returns of 13 to 15%. These Brazilian equities delivered positive real returns in over 80% of rolling 10-year windows during that era. Global diversification acts as a structural shield, preserving wealth even if a local economy struggles. The final requirement is a commitment to hold these diversified assets for minimum 10-year periods. Equities do not beat inflation every year. Short-term drops in 1973, 2000, and 2008 were severe. Investors who sold locked in their losses. Conversely, those who held saw their portfolios recover and reach new peaks. In this environment, patience becomes a mandatory mathematical strategy rather than a matter of temperament. Data from the last 200 years confirms that holding a globally diversified equity portfolio for 10 years beats inflation 94% of the time. Short-term volatility is the price of admission for long-term safety. This is your blueprint. Audit out your cash, prioritize productive assets, diversify globally, and commit to a 10-year horizon. Comparing these paths reveals the difference in outcome. The teacher's $340,000 in cash shrinks to $280,000 in real value. Her neighbor, the electrician, invested his savings in the S&P 500, and his portfolio grew to $780,000. Like the New York janitor we discussed earlier, the electrician succeeded because he aligned his money with historical data. He endured the crashes of 2008 and 2020 to reach that final result. True financial safety exists in the presence of purchasing power. Share this blueprint with someone who needs to rethink their savings, and subscribe to stay ahead of the historical patterns that define our world.